Welcome to this Killick Explains Finance video. This week, as we hit the end of the year, I thought I'd look at 3 investing lessons from 2019. Now, there are more than 3, one could argue, but let's have a look at 3 that are good takeaways as we head into 2020. So the background would be what? Another year is almost over. It doesn't take me to tell you that. What are its key lessons for investors? I reckon I've got a top 3 ready to go. Oven ready, you might say. So, number 1, be wary of crystal balls, as I call it. What do I mean by that? Basically, we're now in the longest S&P bull market in history, and the election result and the conclusion, or at least the hope of the conclusion, of the US-China trade dispute has propelled the market on even further as I'm actually shooting this video. The MSCI World Index has returned around 150%, slightly over that since January 2010, and therefore predictions that the world would end have so far proved unfounded. And that's not to say you should be some ludicrous perma-bull who never believes stock markets can fall. That is clearly not what I'm saying here, but beware of forecasts, because almost at the end of every year for the last 5, substantial numbers of people have come out and said it's the end of the bull market, it's the most hated bull market in history, it's all got to end, and actually with a few sizable blips, I'll give you that, we're still in it, it would seem. So, it's not just equity market forecasters who are wrong either, by the way. The consensus 10-year yield for the end of 2019 was 2%. It's around 0.75%, it's a moving target as I talk right now. Who cares? I mean, the numbers are less important than the fact that the equity market hasn't yet collapsed and the bond market also hasn't yet collapsed. And there were plenty of people forecasting what happened. Now, bond prices could correct at some point. They're almost bound to. That's the yin and yang of markets. But it's a dangerous game to keep forecasting their demise on the basis of, well, it's got to end at some point. You know, bull markets don't generally die of old age per se. You need other factors to be in play first. So takeaways. Market timing remains a full game. Predictions, market timing, never a good idea. I've mentioned it before, that JP Morgan statistic that says between 2003 and 2013, if you'd missed just the 10 best investing days, which came after 10 of the worst, that's the irony or catch-22, you would have halved your returns over that decade. So constantly getting worried about forecasts, trying to reposition yourself accordingly is probably not going to make you money over the long term. And it's not even necessary if you plan correctly. We talk all the time, or I talk all the time, about setting up that rainy day fund. That's the one you can liquidate if you need to meet a short-term emergency. Working out where your foreseeable calls on capital will land, whether that's helping a child with a wedding, school fees, buying a property, whatever it might be, and allocating capital accordingly in relatively safe baskets, and then allowing the rest of your wealth potentially to grow as equity-based long-term investments. And that approach is better than trying to dip in and out of the market on a regular basis, timing these dodgy forecasts. Number 2, don't be distracted by noise. I've covered this before, but this year has been a demonstration of it. The last decade has arguably been a demonstration of it. So what do I mean by that? Investors have had plenty of reason to be sideswiped by geopolitics. There's been lots of things for bears to hang on to and say this time it's different, this time markets will collapse, if you like. Events, dear boy, events, as Harold Macmillan once said, and these can be divided into last decade, so you can take a long-term view on this if you like, and the last 12 months. So let's take a look at a selection of things which could have derailed markets but actually haven't. I'm not saying there aren't events out there that could derail markets in the short term, but there's no point in trying to second guess them. Get your investing approach right, all right? Don't try and time any of this lot, because if you had, you would have damaged quite substantially potentially your return from equities. So Eurozone debt crisis going back, the oil price spike and crash, there's doom mongering around all of these, populist uprisings, all right across Europe at one point. The Arab Spring was another one that's going back a bit, and the end of the commodity supercycle. Those have all been used as levers for people to say, well, now the world economic backdrop has fundamentally changed. Over the last 12 months, we've had Brexit and another UK election to distract everybody. We've had Trump, still got that, with the US 2020 election impeachment, the trade war, you name it. There's the trade war mentioned there, and a slowdown in China and Europe. So take the trade war out of the equation, which is bad enough, and you've got evidence that two of the bigger continents on the planet might be slowing simultaneously. And yet, the US consumer appears to be in fine fettle and driving one of the bigger economies forward as they do so. So the point being that all of these things can be used by the media, for example, as a trigger to say, right, we've hit the end of this long and deep bull market, which we will do at some point, but it's dangerous to try and just call it on the back of one set of facts. Takeaways then. Limit the amount of media and social media news you absorb. That's good advice for your psychological health as well as your investing health. Stick to analysing fundamentals. In other words, look at what's actually changed rather than being distracted by the latest short-term event. And don't try and second guess how markets will react to news or when. And I've shown examples of that, where companies, for example, have seemingly disappointed with their latest announcement, yet stocks have risen. All right, so you can't predict necessarily how markets will react and to what extent to either big macro bits of news, GDP data and so on, or micro company-focused results. Finally, the stock market is not the economy. Made this point before, but 2019 makes the point again, if you like. So, some data first of all. Global GDP growth has averaged 4% over the last 10 years. And yet, the MSCI World Index has averaged 10% as I talk over the same period. Well, that's quite a big distance. Why? Right, 4% plays 10%. Surely the stock market is the economy and vice versa. Well, kind of, but the relationship's complex. So, we've got to set aside against that the action of central banks. Now what I mean by that is the central bank put, as it's called, central banks cutting interest rates, adjusting the amount of tightening or loosening they do in terms of quantitative easing, quantitative tightening. That has had clearly quite a big impact on asset prices. We've got multiple expansion. That is the idea that even if earnings are currently not growing very quickly for companies, markets can price in an expectation that they might, or price in an expectation that actually equities are safer in some respects than other asset classes. So it's complicated. And there's the dog versus dog walker effect that I've mentioned in other videos. The idea that yes, over the very long term, the stock markets and economies will tend to converge on each other, move in tandem. But actually, a bit like watching a dog flying around a park as the dog walker crosses the park, they'll end up at the other end of it eventually, but they take very different routes to get there. Takeaways would be what? Following big economic data points is valid. Macro backdrop matters to markets, but don't become a slave to them. Stock markets can change quickly, but economies generally don't. All right, so just be careful. The stock market can go through a phase of quite severe volatility. Doesn't necessarily mean that the world is about to end. Diversify, diversify, diversify. I mean, just to give you an example this year, the pound has been on the floor, if you like, relatively speaking, thanks to a combination of Brexit, uncertainty of an election, and suddenly towards the end of the year, bang, up it goes by an astonishing amount in a matter of a few days, as there's been a Conservative majority, okay, and people start to think about, well, maybe there will be some kind of Brexit resolution, who knows? Well, that just goes to show, if you're diversified, that won't matter as much as someone who's tucked in one corner of the global market and therefore potentially quite exposed to different currency fluctuations. You want to take advantage of global growth opportunities, and you want to do so in such a way that doesn't leave you sweating short term about what individual currencies are doing. To find out more, editor@Killick.com, and if you want to watch videos that are related to this topic, Killick.com/learn. Tabs down here, shares would be a good one.